Good morning. One of the famous quips or quotes in the world of investing goes that investing is simple but not easy. And what I'd like to explore in this keynote is some of the basic foundations, the key principles that underpin getting investing from not just simple but also to easy. And to kick off the discussion about the headwinds or the challenges that face us as investors, I think it's first worthwhile to square up to public enemy number one. And very often when we think about the things that challenge investment results, ideas, principles, arguments that spring to mind are attributes like volatility, tax, which currency do you achieve your returns in? And all of these matter, make no mistake, all of them are relevant and impactful, oftentimes in negative ways, on investment destinations or investment results. But the single greatest threat to investing is the risk of inflation. If we take the case of South African inflation, just as a talking point, I've got an illustration here of the cost of buying a South African favorite, Kentucky Fried Chicken. And if we rewind to the 1970s and we compare the price of buying a bucket of chicken from the 1970s to buying a bucket of chicken today, the differential is 30 or 40 times. What's happened to the key attribute of the product is essentially very little. In fact, Colonel Saunders assures us that is the exact same secret recipe that's so successful. And so what has happened over the course of these 40 years, it's not that chicken has become more expensive or that making this particular product has become harder or more challenging. It's that our currency buys less. And that is the public enemy number one. The next slide shows you the impact of this, the differential between the impact of tax rates on a terminal return and inflation. And just for the sake of an illustration, what I'm showing here is, imagine that you put 100 into an investment portfolio made up only of cash, and then you let that very stable, smooth asset class compound over 50 years from the late 1960s to now. What would you get? And the differential that you see in this chart is made up of three components. The first is the wonderful compound return that you will get, and then we disrupt that for the two negative impacts of tax and inflation. And overwhelmingly, it is inflation that eats the bulk of the return. And I think this is a fundamental point of departure in thinking about what really is the investment objective. Is it to beat the market? Or should it rather be to beat public enemy number one, this thing called inflation? To be flippant about this, the next slide shows you that there is no such thing as a person who has perfect immunity, and we can go to the dad jokes very quickly. So here you've got the cost of being Superman or Batman, the year of birth, somewhere in the 1930s, and the cost of being them today. And perhaps for Batman, it's much more expensive because there's all types of technological gadgetry that come along with being Batman. But for Superman, it's pretty much the same equipment, just the underwear's gone on the inside. But the cost of living has risen substantially. So it's the same things costing substantially more. And it's not that these things have become scarcer. The point again about inflation, it's that you need more money to buy the same stuff. That is the challenge of investing, the core challenge of investing on the back of these principles. So how then would you square up to this challenge? And there's some data here which suggests that the easy way to square up to inflation is just to worry about asset classes. And this often takes us to being equity-centric in building solutions. The evidence that you see here shows that one of the best ways to beat inflation over long periods of time is just to buy equities and to hold them. And if we then move this to a further illustration, this next illustration shows you that on balance, equities do deliver this very good result. The however, and always in the language of economics, finance, investment strategy, there is always a however. And the however is this wonderful long-run compound return comes at the cost of volatility. And that volatility can then make the appetite, the ability to palate this long run that much harder. A great example of just how difficult this can be and how we get caught in the headlights of market fascination is shown by the return on the NASDAQ index. If we rewind to the late 1990s, there was a market fascination with NASDAQ, the suggestion being that the simplest way you would become powerfully successful in investing was to buy a single asset class, technology stocks, and own them forever. The most money that ever went into NASDAQ in a single month occurred at the market peak, and it's flagged on this chart. The most money that ever came out of NASDAQ happened almost at exactly the bottom, the market trough. We're told in investing that the key is to buy low and sell high, and you can see here that the behavioral attribute is to do the exact opposite, that what human behavior is doing is it's getting in the way of compounding. It's biasing decisions to do the exact wrong thing, and instead of buying low, sell high, to buy high and sell low. So there's a well-known cartoon from some years back where the proposal is put that we've met the enemy, and the enemy is us. And this then takes us back to that opening quote or quip that investing is simple but not easy. And so what's getting in the way of that ease of investing is our decisions, our behaviors. The point is well made by Morgan Housel, who shows in these two charts the biases or the biases of investors based on their decade of birth. And investors who are born in particular times tend to anchor on asset classes that have then gone on to do well in their early years of getting into the workforce, their first experiences with investing, their first pension fund experience, and so on. And so there's at least two big arguments here to then talk about what gets in the way of making this simple thing called investing difficult as opposed to easy. And the first is that we are hypersensitive to context. And the second is that our decisions and our direction is heavily influenced not only by that context, but by our human wiring. And one way of illustrating how impactful this human wiring can be is it doesn't matter how many times we look at this behavioral exercise. Some people will see the dress as white and gold, and other people will see the dress as blue and black. And we're about 50-50 on this. I'm in the white and gold camp, but there are people who are looking at this behavioral exercise and they are absolutely convinced, as much as I'm convinced that this is white and gold, you're convinced that this is blue and black. And so that's our wiring, and that's the context. So the owner of the famous quote, "Investing is simple but not easy," of course, is Warren Buffett, who needs absolutely no introduction. And if we take the powerful points of Buffett, that what gets in the way of investing is us being confused by context, that it is our behaviors and our decisions that are some of the biggest challenges, and that what we're really squaring up to is not beating the market, but beating public enemy number one, called inflation. How do we set about then laying the foundations for successful investing? And there's 5 principles that I'd like to put on the table in this presentation or in this address. The first is that the single most impactful influence, the single biggest determiner of your terminal investment return is time. There is absolutely nothing that is more powerful, more effective, more important than giving your investment portfolio time. If you had a wand to add one magic ingredient to your investment result, if you had the ability to add a magic ingredient to your investment result, the thing that you should ask for is time. Either to be able to live longer, longevity, or to get the keys to a time machine and go backwards so that you could start earlier. So if you're going to do one thing that's going to make your investment result better, start today. Do it today. That is the fundamental grounding principle. The second point is that fees matter. And it's not to say that what we should be doing is getting fees out of the equation to the fullest possible extent, and that the only thing that we should pursue is the lowest possible fee. But if we take equivalent investments and add fees, fees eat while we sleep. So there's a lovely piece of research here which I can show you from Morningstar, and it shows the success rates of investment portfolios across different mandates, from pure equity mandates, bond mandates, industry-specific mandates, multi-asset mandates. And the Manhattan skyline that you see here shows you the investment portfolios that have the greatest success through to those that have the lowest success. And the distinction as we go through each of these mandates from left to right is that the fees on the mandates is going higher. So the single biggest determinant of success in your investment mandate, based on this Morningstar research, multiple mandates, multiple years, is fees. That's a very powerful due diligence question to ask. The third thing that another piece of Morningstar research shows us is that one of the most effective ways to get investment results is not to try and beat the market, but to match the market. Bernard Baruch, in this lovely quote, tells us that if you want to be an expert in identifying market winners, that it is an incredibly challenging, intricate, complex task, and that we almost set ourselves up for failure given the incredible complexity of context, decision, the multiple moving parts, all of the intricate pieces of the investment machinery and equipment that you need to know. So if that is the case, then the argument can be made that rather than trying to beat the market, you might want to just match the market. And this is what we would call passive investing or index investing. And the next piece of evidence makes exactly this point, that the success rate across mandates is explained then by a combination of getting fees out and matching the market in. So you see here measured over long periods, 5 years, 10 years, 20 years, the number of active managers that beat their market. And I've spent a fair share of my investment career trying to build investment portfolios that beat the market. Make absolutely no mistake, it is an incredibly complex, extraordinarily difficult task. And so beating the market arguably sets us up for disproportionate failure. That doesn't mean we shouldn't try, but we must recognize if we are setting ourselves up in a portfolio that is made up only of things that are supposed to beat the market, we might be setting ourselves up for failure. The fourth critical foundation of successful investing is diversification. And this is the freest lunch. If there is a single free lunch in investing, it's diversity. And that diversification is about owning multiple asset classes, and asset classes don't just have the same thing with different names. So if you own Brazilian equities and Indian equities and South African equities, you actually aren't very diversified. Rather, you have a basket full of emerging market equities. Effective diversification means that you own things that actually look very, very different. They don't just carry different names, but they behave differently. So a diversified portfolio would own things like inflation-linked bonds, physical commodities, precious metals, emerging market equities, some private equity. That would be a fully diversified portfolio. And the next chart shows you some of the results that you can anticipate by way of effective diversification. The last point about ways in which we can lay an effective foundation in investing is to manage ourselves. And that rewinds all the way back to one of the opening arguments, that we know who the enemy is, and the enemy is us. And how do we manage ourselves? Robert Shiller, the Yale University professor, says that one of the ways in which he's able to get into the market, hold a effectively diversified portfolio, not try and time the portfolio, is to own things that allow him the ability to exercise discretion, to get engaged with some of his fantastic business ideas, in inverted commas, to have fun in the investment market. And there's no way that I can hide this, shade this, disguise it. I'm absolutely fascinated with investment markets. 35 years of investing hasn't changed that fascination. I'm intrigued with understanding what drives investments, what causes decisions to be right versus those that are wrong, what makes for effective investment results. But how do you marry that with the discipline of getting in the market, getting asset classes right, and just leaving that thing alone to allow it to get on with compounding? So Robert Shiller gives us a clue. And he says, what if you allow yourself a small pocket of distraction, and you can invest all of your distracted time with that fascination? And his rule of thumb is an 80-20 principle. He says 80% of his investment portfolio is in the responsible, sensible things. 20% is given to his fantastic best ideas. Some of these really will be fantastic and brilliant. Some of them won't work out so well. But when you blend that 80-20, it's the 80 that's going to get you effectively to this safe terminal destination based on these 5 founding principles. So a closing set of ideas, what I think might be 2 really interesting investment ideas in this landscape. In a world of 6.5% inflation in South Africa, 7 and 8% inflation if you're in Europe or the US, rising interest rates, falling equity prices, volatile currencies. What about real estate as an asset class? This would seem to be an outrageous proposal, because real estate doesn't like a rising inflation. Real estate does not like sluggish growth. But here's a portfolio that is made up of thousands of tenants with 85% and more occupancy rates and rental increases with inflation plus uplift. And it's in the property portfolio called storage, which gives you a 7.8% dividend yield with this 85% occupancy rate. Half of the portfolio is now in hard currency, sterling, and the business has steadily grown dividend year after year since listing almost 10 years ago on the Johannesburg Stock Exchange. If we add in not just dividend yield, but also capital appreciation in a fairly choppy and difficult investment environment, storage gives you a 16% return over the past 12 months. And based on valuations plus yield, we suspect that there's a lot more to come from this niche real estate business. A second idea is to diversify away from yourself, to own things that aren't you. And an idea in our global portfolio is in the healthcare industry. So things that aren't investment finance or things that aren't a strategy professor is the healthcare industry. And some elegant attributes of the healthcare industry is you've got quite powerful structural drivers of healthcare in the advanced world, including an aging demographic, younger retirement ages, higher life expectancy, and growing incomes and strong balance sheets, so that people have the capacity to look after themselves in old age and retirement. Governments that are placing increased emphasis on healthcare and recognizing that about 80% of your lifetime healthcare will be spent in the last 3 years of your life. And so here are some ideas about diversification that are not just about owning different asset classes, but about owning things that aren't you, such as healthcare businesses and robotics businesses or equipment businesses in the healthcare arena. If we put all of this together as a closing set of ideas, three principal arguments. Public enemy number one is inflation, the enemy is us, and investing is simple but not easy. To make investing easy, if we can lay the foundation of these five basic principles, get in, stay in, get fees out, all else equal, diversification, own the market rather than trying to beat the market, and then manage ourselves by allowing ourselves the distraction in this simple 80-20 principle. For instance, we might have set the basis for beating that public enemy number one and the enemy that is ourselves. Thank you for your time. I hope that those ideas translate into very successful investment results.